Hello guys. Hello guys. How are you doing today? Hope you are fine. It has been a while that I posted a video, so I want to briefly show you how to recognize a trend or how to identify a trend. I posted it on the WhatsApp group. I posted an image on the WhatsApp group and I want to make you guys understand. I want to make my viewers understand what I mean by the tools in the image. So listen. How to identify a trend on the image. I have Fibonacci levels, I have support levels, channel patterns, flag patterns, volume, moving average crossover, and Elliott waves. So what do I mean by that? It means that these tools are what you can see or use from TradingView in order to be able to identify trends and know whether you are in an uptrend or in a downtrend. So I will start with the Fibonacci levels. The Fibonacci levels is simply a tool that can help you to identify the premium and the discount level on a price action chart, which will tell you whether you are shorting from the right premium zone or buying from the right discount zone. So on the TradingView, from the toolbar, you can see your Fibonacci retracement tool from the top. The shortcut for a Fibonacci retracement tool is Alternate F. And when you click on this star, it will be added to your favorite tool. So how do you draw a Fibonacci retracement? How do you draw Fibonacci retracement? Drawing Fibonacci retracement is done by selecting the tool and clicking on the swing high and the swing low of the point that you are considering to either buy or sell. I will take, for example, this place right here. Let me rewind this. Let me rewind this to this point. Or rather, let me take it a bit back to this place. So imagine you are on a chart right here and you want to trade. The Fibonacci retracement tool will help you know whether it is the right place to buy or to sell in terms of discount and premium. So I've selected the two right here. So all I need to do is to click on this swing low and go up and click on this swing high. You will see what it will form for me. I have already edited my Fibonacci retracement tool to look like this. So the 1 to 0.5 level is the discount zone where you can place buy orders. It is safe to buy at this level. And the 0 level up here is the premium zone where it is safe to sell. So let us assume that we want to buy right here. All we need to do is to draw our Fibonacci retracement tool and wait for price to come around this level so that we can make a buy, because we are looking for a safe discount zone. As you can see, price moved fast. After price went up, it dipped down here massively. It was a massive move that came down to this discount zone, and this is the right place. This level is the right place to be placing your buy signal, so that when you place buy from right here and put your stop loss on this swing low, you could be targeting this swing high, for instance. That is the liquidity, right? That is where the liquidity is. That's why I'm targeting this swing high. And it will be easier for you to make trades that will work. That is the work of the Fibonacci retracement tool. So another tool that is in the image is the support levels. How do you know the support levels? The support levels are simply the swing high. This did not hit TP, but every trade will not work. But I'm telling you that when you have your premium and discount level, all you need to do is to wait for price to retrace to that level so that you can click your buy and your sell. The next one is the support levels. I will use an uptrend to show you what a support level looks like. When price is trending up, the swing highs, they are the support levels. The swing highs are the support levels. When price is trending up, let me go down. So in this uptrend right here, this swing high to this is the support level. As you can see, price respected the support level and went up again. So the swing highs only, they are the support levels of where you should be buying, of where you should be placing your buy orders. This is another support level. The swing highs, they are the support levels. The same thing happens in a downtrend. I will check whether I will see another example of an uptrend of a swing high acting as a support level. Look at it right here. So this swing high is a good level to buy right here. So when price came here after this massive move, it came back to this support area, and you can still target this swing high. And if you took this trade, you would have made a profitable trade because it hit the profit here, and your stop loss will be somewhere here. So this is a nice trade still. The same thing happens in the downtrend. The swing lows at the resistance level for a downtrend. Look at this guy here. The swing lows. So you can see price came here. Then there was a smart money manipulation before price started trending down. The swing lows in a downtrend, they are the resistance level. I will look for a clearer example for you so that you will not be confused. The swing lows, price will always come back to that level to respect it somehow and start going down. Another tool to identify a trend is the channel. Channel patterns is simply using your trend line tool to mark out the price movement so that you can be able to tell whether price is about to go up or to go down, and you wait for a breakout. For example, if we had marked this place out as our channel when price was here, you can see we are dealing with something that looks like a flag, right? So if we had this right here when price was trending, you can see that this is simply a channel. Price is ranging and it is a channel. All we have to do is to wait for price to either break out from the upward side this way or to break down this way before we can enter a position at either this swing low or at this swing high. Remember that the swing lows and the swing highs are the support and resistance level. So if we take this trade, for example, and considering this channel, let's see where price broke out. See, price broke out right here. That means that we are going to be taking this place as our new support level will be buying around here, right here. So as our channel has been broken out, all we need to do is to wait for price to retrace to this place, to this level, so that we can take a buy. That is simply how you recognize trends with channel. As that is counting, uh, the volume bar or the volume tool can be added to from your trading view. But first of all, let me show you how to use a moving average to identify a trend. A moving average is a tool that calculates the average price of a commodity over the period of time that you set it. For example, if you are using a 21-day moving average, it means that it is calculating the price over the past 21 days, right? So all you need to do is to search your moving average tool from the right here. I already have my moving average tool right here. So this is my, okay, as you can see, price respected this swing high right here up to this place. See how we traded this breakout? Just right here, price was able to use this support, this swing high as the support area to make this massive move up right here. So did you see how we used this channel and this breakout to determine our entry point? All you needed to do is to wait for price to retrace, okay? And don't enter into any trade hurriedly without considering what price is telling you. Only patient traders will make it in this space. So let me clean this. Okay, let me not clean this off. Let me just weekly bring out my moving average too. Remember that moving average is forms a dynamic support and resistance area. So this is my 21-day moving average. What is moving average telling you? When price is above the is trending above the moving average, it's telling you that the price is going higher. And when price is below the moving average, it's telling you that the price is going lower. So for example, this is my 21-day moving average. What you can see here is simple. When price crossed this 21-day moving average, price remained under it and kept on going down up to this place. So it works best in a trending market. Moving average strategy works best in a trending market. And what you need to put into your head and remember always is that the moving average acts as a dynamic support and resistance level. As you can see right here, as price went down and shoot up, the moving average acted as a resistance level for it to continue going down. And it is similar for an uptrend. The moving average acts as a dynamic support level as the price trends up. Look at a moving average acting as a support level as price is above the moving average. This is below, this is the above. So this is price action, right? Look at the moving average below it for an uptrend, and look at the moving average acting as a support for this uptrend that we are seeing right here. So another tool that you have to put into your mind is the moving average crossover. What is a moving average crossover? A moving average crossover is simply when you have two moving averages on your chart and the lower time moving average crosses above the higher time moving average to give you a buy signal. And when the lower time moving average crosses below the higher time moving average, it is giving you a sell signal. And that is called a death cross in the market. For example, now I have my 20-day moving average. Let me quickly bring out my 50-day moving average and show you what I mean. My 50-day moving average is in red. My 21-day moving average is in blue. Let me show you where price crossed over to, to signify a date cross, which means that price have started trending down. Some people use it as their strategies for entering into a trend. Look at what happened here. When the lower time frame moving average, which is the 21 moving average, crossed over the 50 moving average, did you see what price started doing? Price started to go down because sellers have started entering the market. I will look for a clearer one for an uptrend. Look at an uptrend. Look at what happened here. After this consolidation phase, you can see that there was a clear crossover of the lower time frame moving average, which is the 21-day moving average, above the 50 moving average right here. And as you can see how price started to continue to trend above the 21-day moving average. It is not a must that you are going to use 21 or 50. It depends on your trading choice or your style of trading. Some traders like to use 50 moving average as their smaller time frame and 100 moving average as the higher time frame. Some swing traders use 100 and 200, Some people use even 9-day and 21 days. So it is depending on your style of trading. So that is all I will have for this video, because I don't want my video to be that long. So you can look out for other tools that you will use to determine the trend, like the volume bars. The volume bars are simply those volume bars that you see that pop out from your screen when you have them. I don't use volume bars as a trading indicator. They're usually long bars that sit below this panel, like long bars like this. You can use it to tell whether the volume of the trend is high or low. But my candlestick have indicates my volume bar right here, or above right here. That is how I use my volume bar. I don't have them per se on the screen, but if you want to add them, you can simply add them as your tool by searching them as you added your 21-day moving average. So that will be all for this video. I hope you enjoyed it, and I will see you around next time. Thank you very much.